You can do everything the financial world advises: auto-invest, diversify, ignore the noise, and still walk away with scars during a crash, while others leave with shopping bags. The middle class gets crushed because they are forced to sell. They lose time, flexibility, and courage because their money is entirely committed. The secret of serious wealth happens before the pain. Berkshire Hathaway hoarded $130 billion in cash before 2023's banking stress. The ultra-wealthy shifted to liquidity in 2006. Well, before the 2008 collapse. The rich aren't braver, they simply aren't trapped by the myth of being fully invested. Finance marketing runs on performance envy, convincing you that staying busy equals intelligence. But what the crowd dismisses as boring, dead, money, cash, and T-bills is actually live ammunition to the patient buyer. That may not sound glamorous. Good. Once you understand why massive fortunes secure liquidity before a crisis, you see that a collapse is not destruction. It is a pricing event. Subscribe, because the next step is where the mask really comes off. Here's the part almost nobody explains cleanly, because once you see the math, the moral language around market recovery starts to sound very different. If you've ever watched a company collapse and assumed everyone inside that collapse got punished equally, that is not how the machinery works. Not even close. Take the structure first. In bankruptcy, there is a recovery ladder. At the top, sit senior secured lenders. Below them come junior bondholders. At the very bottom sit common shareholders, the regular people holding stock in a retirement account, a brokerage app, or an index fund. When the company is finally restructured, that bottom rung is usually erased. Read that again in plain English. One person thought they owned part of the company because they bought the stock. Another person bought the company's debt after panic had already crushed the price. Howard Marks built Oaktree Capital into one of the largest alternative asset management firms in history by understanding this exact asymmetry better than almost anyone else. In October 2008, while markets were in freefall and most people were staring at red numbers like they were watching blood drain out of a screen, he sent a memo to clients arguing something most of the public still misunderstands. Distressed debt is not a casino bet on whether a broken company magically survives. It is a legal claim. A claim that can convert into ownership of real assets at a tiny fraction of what those assets would cost to build, buy, or replace. Now, put numbers on the table, because this is where the intellectual escape routes disappear. If debt trades at 15 cents on the dollar, that means a claim with a face value of $100 can be bought for $15, not $80. Not $60, $15. If that claim later gets converted into equity during restructuring, the buyer has effectively positioned themselves to control assets linked to that $100 claim after spending only $15 up front. Even before you argue over final recovery rates, legal complexity, or dilution, the entry math is brutal. You are not competing with someone who bought a stock and hopes sentiment improves. You are competing with someone who purchased seniority in the capital structure at an 85% discount. That 85% gap is the whole game. And while ordinary investors are being told to stay calm, keep dollar cost averaging, and not panic, sell their shares, the people with access to this market are buying the company from above them in the stack. Same building, same business, completely different legal position. One person owns a lottery ticket on the bottom floor. The other owns the fire exit, the deed room, and the first lien on the furniture. You saw this play out in real life with General Growth Properties. At the time, the second largest mall operator in the United States. It filed for bankruptcy in April 2009. The market treated the business like a corpse. Its debt traded for pennies. Brookfield Asset Management accumulated meaningful positions in that distressed paper. Then in November 2010, when GGP emerged from bankruptcy, Brookfield held a controlling equity stake in a company managing more than 200 shopping malls worth billions. And then the second piece of evidence makes the divide even uglier. The Capgemini World Wealth Report from 2010 found that high net worth individuals who maintained allocations to alternative credit strategies during the 2008 crisis outperformed standard diversified portfolios by 23% on average over the following 3 years. 23%. That exclusion matters. Retail investors are fenced out by regulation, by minimum investment thresholds, and by deliberate opacity. Look at the pattern hiding in plain sight. In 2023, reporting from the Land Report, backed by USDA records, showed Bill Gates had accumulated roughly 270,000 acres of American farmland across at least 18 states. Most people heard that and filed it under billionaire eccentricity, maybe a hobby, maybe a vanity project. And farmland is not just land. That is the first mental correction. It is not empty dirt sitting there like a decorative store of value. It is productive capacity. It is acreage that throws off output, tied to calories, tied to supply chains, tied to demand that does not disappear because CNBC changed its tone. People can postpone buying a car. They can delay remodeling a kitchen. They cannot opt out of eating. That is why this behavior repeats across centuries with almost mechanical precision. In ancient Rome, during debt crises, smaller farmers fell behind on obligations they could no longer service. The aristocratic class, already liquid, stepped in and absorbed public land and distressed farms. The latifundia expanded not because the rich worked harder in the fields, but because they had claims on ownership, while everyone else was trapped inside liabilities. Same with post-Black Death Europe. Same again in post-World War I Germany, when the currency was collapsing so fast that middle-class families could not keep up with the real burden of mortgages, while those holding hard currency moved in and bought farmland at prices that would have looked impossible just a few years earlier. That is the hierarchy nobody likes to name. The system does not reward sacrifice first. It rewards legal claims first. Labor comes second. Savings in weak currency come third, and unsecured hope comes last. You can feel this hierarchy in ordinary life if you zoom in. One person wakes up to a paycheck, a rent increase, a grocery bill, a car payment, and an investment account swinging with headlines they do not control. Another person wakes up owning the field that grows export crops, or the company with pricing power, or the debt that can become equity, or the asset that global buyers compete for. Both may say they are investing, but one is trying to protect purchasing power. The other is standing upstream near the valves. That is why not all assets deserve to be spoken about in the same tone. During Venezuela's currency collapse after 2015, farmland linked to export agriculture, coffee, cacao, tropical fruit, held real value far better than urban commercial real estate denominated in bolivars. That contrast matters. One asset was plugged into global demand and foreign currency buyers. The other was trapped inside a local monetary system that was disintegrating. Same country, same crisis, completely different outcome depending on what the asset was actually connected to. So when people say, land always goes up, that's too lazy. The real dividing line is not land versus no land. It is whether the asset has external demand, durable utility, and a claim on something scarce that survives monetary damage. A field producing exports is not in the same category as a speculative parcel with no productive yield. A trophy office tower in a failing currency is not in the same category as a productive asset tied to dollar flows. Ownership is layered, and the people who keep surviving these cycles understand those layers far better than the people being told to just stay disciplined and keep contributing monthly. The same social sorting shows up in another asset class that sounds almost offensively distant from normal life: blue chip art. Not because art is magical, not because rich people have better taste, and not because aesthetics somehow become an inflation hedge. The mechanism is colder than that. Walk into Sotheby's in New York 4 to 6 months before a major dislocation, not into the public rooms where the theater happens, but into the private treaty department, where transactions occur by appointment, relationship, and referral. That is where you can watch one layer of wealth reposition without broadcasting the move to the public. Over roughly 50 years, data from Sotheby's and Christie showed private treaty activity surging in the 18 to 24 months before major downturns. It happened ahead of 2000. It happened before 2008. The pattern appeared again around late 2019 into early 2020. Why? Because public markets are liquid, visible, and emotionally contagious. Private transactions are quieter. They let wealth move from one form into another before panic turns everything into a headline. And again, the key divide is not art lovers versus non-art lovers. It is owners of finite supply versus holders of paper claims. A major work by an established dead artist cannot be printed, It cannot be conjured by emergency monetary policy. When the Federal Reserve can expand fiat supply by trillions in a single month, any asset with permanently fixed supply begins to act differently. Not because it is glamorous, but because it is insulated from the one thing crushing savers in these periods: dilution. Look at the comparison. When the S&P 500 dropped 57% from 2008 to 2009, the top segment of the art market fell about 4%. That gap is not taste. That gap is class structure expressed through assets. One group is sitting inside instruments repriced every second by fear, leverage, and forced selling. Another group is sitting inside scarce objects with deep collector demand, institutional provenance, and almost no correlation to public equity panic. One group watches numbers, flash red, on a phone. The other negotiates privately, with time, from a position that does not require immediate liquidation. So who gets systematically harvested? Usually the person whose entire balance sheet depends on wages, whose savings sit in a currency being diluted, whose investment behavior is reactive, and whose largest obligations are fixed while their asset ownership is thin. They are told the crisis is a test of patience. For them, it often is. But for the owner class, crisis is not mainly a test. It is a sorting event. It reveals who owns productive capacity, who owns scarcity, who owns claims on future cash flow, and who only owns exposure. That is the emotional sting under all of this. The middle class is trained to think in terms of budgeting, discipline, and monthly contributions. All useful, none sufficient by themselves. Because discipline without ownership just makes you a more efficient carrier of inflation risk. You become more responsible inside a machine, still positioned above you. You clip coupons while someone else owns the field, the patent, the senior debt, the royalties, the private business, the export stream. And once you see that, a lot of financial advice starts sounding incomplete on purpose. Don't try to time the market. Fine, for most people, panic trading is destructive. But that slogan becomes misleading when it hides the fact that the real game is not prediction. It is migration. Quiet movement out of vulnerable claims and into stronger claims long before the public feels the event. The winners are not necessarily smarter at calling the exact date. They are simply positioned in assets that get less fragile as money gets more fragile. That is the layer you cannot afford to miss. Crashes do not just destroy wealth. They reassign ownership. And they usually reassign it away from people who worked for money and toward people who already owned the things money was trying and failing to measure. Here's the part almost nobody tells you, because it sounds too small to matter. If you are not a private equity firm, not a family office, not sitting on millions waiting to buy a waste route or a funeral chain at a distressed multiple, then your move is not to imitate the purchase. Your move is to retrain your eyes. Because most people lose money in a downturn before they ever lose money in a portfolio. They lose it in attention. They start consuming predictions, personalities, panic, fake certainty, comment section profits, and smart money theater. So the first mechanical move is brutally simple. Open whatever notes app you already use and create one line only, needed no matter what happens. That is the title, nothing else. Then write 5 categories under it: trash, water, storage, basic health, debt obligations, not stocks, not tickers, just services. Every time you hear a hot take, every time somebody screams recession or soft landing or hyperinflation or all cash now, you do not react. You return to that note and ask one dead boring question. Would people still pay for this if they were scared, laid off, downsizing, sick, or broke? If the answer is no, stop there. No debate. No heroic analysis. You are not trying to sound informed. You are trying to stop donating your attention to stories that collapse the moment the economy gets ugly. That sounds almost childish, but that is exactly why it works. Old habits die in drama, so you replace them with friction. The person who gets trapped every cycle is not always the person with the worst income or the smallest account. It is usually the person who keeps making decisions inside an emotional weather system. One day they are told never to time the market. The next day they are told to rotate defensive. Then someone says bonds, someone else says Bitcoin, someone else says all advisors are scammers. And now the brain is spinning, not allocating. So make the rule physical. Put a 24-hour delay between any new financial idea and any action. Not forever, just one day. If a video post, newsletter, friend, or commentator makes you want to buy, sell, move cash, or finally do something, you write the idea on paper and wait until tomorrow. During that wait, you check it against the same note. Is this tied to a service people cannot stop paying for? Or am I just reacting to somebody else's certainty? That single pause won't make you rich. That's the point. It will make you less harvestable. And if you do have capital set aside, maybe at $5,000, maybe at $100,000, the boring action is still not prediction. It is sorting. Divide what you are looking at into two buckets only: can be postponed and cannot be postponed. Most consumer demand lives in the first bucket: new furniture, premium subscriptions, trendy gadgets, nice-to-have software, lifestyle upgrades, restaurant concepts dependent on confidence, brands that need people feeling flush. Those are fragile when households get punched in the mouth. The second bucket is where the uncomfortable truth lives. Waste still gets picked up, water still gets treated, medical waste still has to be processed. Pest problems do not care about unemployment data. Storage demand often rises precisely when people are being forced out of larger homes. Funeral services do not ask the Fed for permission. You do not need access to private deal flow to understand the difference. You need the discipline to classify reality before narrative gets to it. This is the mechanical habit I'd keep if I had to strip the whole framework down to one action. Once a week, same day, same time, 15 minutes, no exceptions. Review one business, one fund, one REIT, one local company, one headline, anything you were tempted by, and force it through the same filter. What happens to demand if households are scared? What happens if credit tightens? What happens if customers delay spending? What happens if unemployment rises? If you cannot answer those questions in plain English without hiding behind buzzwords, you do not touch it yet. That routine is dull on purpose. Wealth-destroying behavior usually arrives dressed as urgency. Protective behavior usually looks embarrassingly boring. That's why almost nobody wants it. But boring is where the edge starts, because boring keeps you from confusing movement with position, and that is the difference between being shaken out by every cycle and quietly standing where the damage has less room to reach you. And this is the part that actually matters, when the camera turns off and your real life is still waiting for you. The point is not to become the person buying private deals in a panic. The point is to stop being the person forced to sell into one. That is a much more useful promise and an honest one. Not riches by next quarter. Not some fantasy, where one clever move cancels out years of bad incentives, rising bills, and market noise. Just a cleaner outcome, more time, more options, less desperation when everyone else suddenly needs cash at the exact same moment. Because crashes do not ruin people evenly. They hit hardest when your paycheck, your rent, your debt payment, and your portfolio all start breaking in the same week. That is why the first layer of compounding is not return. It is survivability. It is the boring gap between what you owe next month and what can be taken from you next month. It is the quiet relief of opening your banking app during a red week and realizing you do not have to touch long-term assets, do not have to swipe a card to cover groceries, do not have to listen to some stranger online telling you this panic is a buying opportunity while your own bills are due on Friday. And yes, that is a smaller promise than the internet usually sells. Smaller promises are how you stay alive long enough for the math to matter. You are allowed to want upside. You are allowed to build. But you should also demand an exit door, a cash cushion, and a structure that lets you step back without blowing up your future.